guys, Paul McLean, and jumping right into Story Sale, the series, and we're talking about right now a client that you sit with, and maybe they just got a 20-year plan and they had to do full physical, or maybe it was non-medical, but there's no ROP, or maybe they just saw something on TV or something that said that they could get 200,000 for $4 and a half penny, right? And they're comparing what you're going to show them to that. How do you kind of get them to see the value in something that is 3 times more than what they're looking at for that 200,000? Let me kind of break that down. So let's just use this scenario. Client is 40 years old. All right. They're looking at 200,000 in coverage, and it's a 20-year product that they're looking at. The premium is $40 a month. And then over here, what you're showing the 40-year-old client for 200K, 20-year term. But the difference is this is an HMS CBO. So the client's going to get their money back after 20 years, but it's not $40 a month. It's $120 a month at the end of it. So how do you kind of illustrate that? So this is how I do it. Now, again, this could be a client that just got a plan maybe a month ago that's what they're paying, and you're kind of stepping in, addressing the situation, going through the financial inventory, understanding what they've got in place, and maybe looking at replacing and putting them into what you believe is a better position. And we're going to articulate this through the story. Or again, they might have said, well, I saw something or whatever on TV, and it was just a straight term. So this is how I break it down. I say, Bob, Mary, listen, that's an absolute great question. So if somebody says something, by the way, I always act like it's a question. So that's a great question, Bob and Mary. And basically the way it works is this. The insurance companies, they're good at a couple things. And as a field underwriter, I know because I look at all of them. So I've had a client that said, Paul, but this one company, they really kind of have the client's, best interest. They want the client to pay a low premium. And the client says, this one was the best. And I said, listen, I will use them all. And I'm on your guys' side, not theirs. Like, at the end of the day, when they put a plan in place, they know that they're hoping it benefits them. And some do more than others. When you look at a 20-year plan, when you're 40, they're looking at what's the odds of you dying at age 60? Because this 20-year plan is going to cover you until you're 60 years old. And then at 60, the plan expires. The 200 grand is no longer there, right? So they're saying, what are the odds? And they say, well, the odds are like less than 2% that the client's going to die before 60. So they're not looking at this $40 premium, or they're not looking at this 200K in coverage that they're going to have to possibly pay out. They're taking a look at the fact that you're going to pay $40 times 12 times 20. You're going to pay $9,600. And at the end of it, guess who gets that money? The insurance company gets the money. So they're going to get that $9,600. So it's going to cost you $9,600. And they know almost with certainty that that's what they're going to end up keeping when it's all said and done. And so I had a client that said, and they kind of did this math. They said, so listen, Paul, they're not looking at the fact that I'm going to die because it's so unlikely. They don't really care what that number looks like because they're not even considering that for the most part. They're just thinking like, okay, $9,600 to get a plan in place. So what most clients look at in your situation, Bob and Mary, is they want to set it up where it's a win-win for them. And so the difference is with this $120 a month, the reason why it looks different is this is a monthly savings. So if you look at 120 times 12 times 20, that's $28,800 in savings. So would you rather pay $9,600 as an expense or have a $28,800 savings? So again, would you rather have a $9,600 expense or a $28,000 savings? And most clients, Bob and Mary, like unequivocally, they say, well, obviously I don't want to have any kind of expense. And if that's most likely to happen, if like you're going to be betting, and sometimes you have to take a look at what are the odds, which is what they're doing. So you should be playing against them and saying like, well, if I look over here, the worst thing that's going to happen is if you did end up dying with that 2% chance and they paid out 200K, well, maybe in 10 years you would have paid in $7,000 more than you should have. So if you look at the net, what you put in, what they paid out, it's like $193 as far as what you've cost the premium, because now that's been more put in. But 98% chance that you're going to get back the $28,000, $800, opposed to spending $9,600 that they keep. Do you see how this right here makes a lot more financial sense, Bob and Mary? Well, yes, I do. And so that's kind of how you get their mind right on it, and you shift that focus, right? Your whole goal as a person that's walking in as a professional for that family is to address the situation, right? And then start to walk them through a different thought process through this story, where at the end of it, they now see this story or scenario the way you see it, right? So again, it doesn't matter how they see it at first. You relate to them. That's a great question to understand. You're exactly right. Like, that does seem, like a big discrepancy. Let me kind of explain what that looks like and how most clients see it and what most clients will do in this situation. And then you just start going through it in detail. And then that last question, do you see how it makes more sense to save $28,000 opposed to spending $9,600? Well, yes, I do. Great. Well, let's see if we get you qualified here. Don't do anything with this one yet until we get you qualified. The moment they say yes, then let's go ahead and do away with that one or stop the premium or what have you. But again, that's the takeaway. So the takeaway is, if they've already had this plan in place, is saying, well, Eddie, before we get ahead of ourselves, don't do anything here. Last thing I want is you to call them and cancel it right now, and then they come back and don't approve it and you got no coverage. This is, they got to look at it. They know that in this end, their odds don't work the same, because at the end of the day, they're giving the money back. So let's make sure you get qualified here, and then we can just call them and stop the premium, and just have them stop the premium after 90 days. It'll just cancel on its own due to premium or lapse, premium failure, and it'll just cancel. But you have free coverage for those 90 days. That makes sense? Yes. So anyways, I hope that helps. That's kind of the story that I articulate when I have a client that's bringing that up, or I'm sitting down with the client that's showing me a policy that they just got in place, and maybe somebody came out and thought that there was value in $40 for $200K. My goal, hopefully by the end of this, is to see that there's really no value in that. There's value in that $120 a month. So I hope this helps, guys. Make it a big week, and we'll talk to you soon. Take care. Bye-bye.